Alright everybody, investing tier list. This is just like on YouTube. There's a million different fad diets. Well, turns out it's the same thing with investing strategies. And I'm here to tell you, not all investing strategies are born equal. Some are bad, some are okay, and some are really bad, and some are actually quite good. And you're going to find out today, ranked S all the way down to rank F, which is the best investing strategy that people generally talk about on YouTube. So for today's comparisons, we have... in option 1, the normie who doesn't invest at all and focuses on his Instagram pictures. That's category 1. Then we have penny stocks. Can these penny stocks 10x? If you put $100, can that turn into $1,000? Is it possible? You'll find out. Then next up is the safer, more blue chip. I like to pick value investing, large cap stocks. Maybe that's the best way to win. If you put in the extra time, you find out the value and you buy at the right price, maybe you have the best strategy. Next up after that is gold. Is gold the best way to buy, especially with these high inflationary times? You don't know the market's going to collapse next year. Could be possible. Then next up, are you smart? Are you mathematical? There's technical analysis. Find out if that's one of the best strategies. We also have options, ETFs, dividend investing, and hype stocks. This should be an exciting video. Coming in at number 1 is the normie. This one was a very difficult one to think about because there's a whole spectrum of normies, right? There are people who are hardworking and honest. They go to their job, but also they just don't know how to invest. So that means that they keep their money inside of their checking account, they keep their money inside of their savings account, and they don't invest it and it doesn't grow with the market. That's one. But then the other end of the spectrum is the normie all the way down to the guy who only cares about his Instagram pictures and the club. And that's going to drag down this category score. Normally, actually, believe it or not, I would put the normie in C tier. And the reason for this is going to be really embarrassing to see, but actually, believe it or not, the average investor doesn't beat out inflation. According to JP Morgan, as of 2018, inflation was 2.2%. The average investor was 1.9%. So that means if you're a normie and you kept your money in your savings account, hopefully that's matching inflation as long as you don't spend it. That's the trouble. As long as you don't spend it, you're matching inflation and beating the average investor who buys trash stocks and loses all their money. So if it were just that, I would put the normie in C tier. But let's be honest, because people have access to their money in their checking account, they're likely to spend it. They're likely to prioritize their Instagram pictures. So unfortunately, that knocks the normie all the way down to E tier. Just because of those two reasons, it's a wide spectrum of people. And also because if you have money sitting in your bank account, your savings account, your checking account, you're more likely to put your hand on it and try to spend it. But that's still better than a lot of other investors, especially you'll see on this list. Next up is penny stocks. Can you put $100 down?
Can we put $100 in there?
It can turn into $1,000.
And walk out with 1,000 down the road.
Can these penny stocks 10x?
These stocks that could go 10 times in a short amount of time.
We're gonna find out today. So I'm going to put the penny stock investing strategy solidly behind the normie in the F tier. And this is because the SEC penny stock investors, penny stock traders, the SEC's got your number. This is just as bad as taking hundreds or thousands of dollars and putting it in lottery tickets. You're just not going to win. It's going to go straight away. And so that's why the normie is more likely to at least keep his money, whereas the penny stock investor is likely to lose it. And as I said before, the SEC's got your number. If we look over here at the statistics, in a study of 10,000 OTC stocks from 2001 to 2010, the results were shocking. The average annual return for OTC stocks was negative 27%, and the median return was negative 37%. Great job. And so also there's a paper on the SEC website. It's called Outcomes for Investors in OTC Stocks. And so if you look at the study here, the sample size is over 200,000. The typical penny stock investor loses anywhere from negative 20% to negative 40%, if not more. And you can see overall 67% of people lose. And these gains, by the way, are relatively minor. And they actually did some mathematical analysis, and the SEC determined that the winners are actually mainly driven by scamming. It's really fascinating. They aggregated the total, and it's about $18 billion a year investors lose in penny stocks. And they hypothesized after doing a statistical analysis that the reason why there are some big winners in penny stocks are because they're riding promotions and trying to pump and dump the stocks. So it's almost mathematically proven that the only people who win in penny stocks are the scammers, and almost everybody loses. The typical loss for a penny stock investor is anywhere from $100 to $1,000. I suspect the reason is because the type of people who invest in a penny stock in the first place don't have a lot of money, so they're losing what little money they have because they're not a very sophisticated and educated investor. And so the cope usually is that, oh, well, penny stock investors don't hold their stocks for a long time. They only hold it for a few days.
Everybody out there, you mentioned a penny stock. It's like, oh, he's going to hold it for 27,000 years. No, you're in and out, folks. This is what it's about with penny stocks.
But in the SEC report, they actually say that the median penny stock investor holds their penny stock for 16 days. And typically on every trade overall, they realize a negative return of 13%. So there you have it. Penny stock investing is solidly in the F tier. Overall, the content creators are incentivized to at best talk nonsense, or at worst participate in some shady things. The system is engineered against the people who are watching them. The ratio of decent content to scam content is through the roof. The entire strategy is structurally flawed because almost every single OTC penny stock is a negative 45-degree knife chart. The longer you're in there, the greater chance you're going to lose money. There's really no upside to penny stocks. Alright, now coming up next are options. Now this is a really interesting one. So options they're a very specific type of investment product, and what they are is a trading contract. So you can buy them in all different forms. It's a very complicated technical field. And so typically you're betting on whether a stock stays the same, goes up, or goes down. But obviously I'm dramatically simplifying it. Basically the idea behind an options contract and how you make money on it is you have to guess a few things correctly. You have to guess the direction a stock will move. You have to guess how much it will move, generally speaking, and also you have to guess the timing of a move. If you don't get those three things right, it becomes exponentially more difficult to make money in your options contract. And so a lot of you shouldn't be surprised because of this, because of how difficult it is. Some of the biggest losses on Wall Street bets of all time are because of options contracts. They're not because of penny stocks, they're not because of anything else, they're because of options contracts. Options contracts have the potential to lose dramatically more money and just as quickly as any penny stock. Now they certainly have a place, so they're not as bad as penny stocks, they just tend to attract more sophisticated investors. So as a result, I'm putting this solidly in the E tier. And the only reason this is not in the F tier, because frankly it's an awful strategy. If you're just a normal person trying to slowly grow your net worth to retirement, you should not be messing with options absolutely under any circumstances, no way. The only reason this is not an F is because there are legitimate uses for options that banks use, that sophisticated hedge fund uses. Those are fine, but also at the same time, they should be outside of the reach of your normal retail investor. And so as a result, with options, the ratio, it's still pretty bad, but the ratio of garbage scam content to decent content on YouTube is better than penny stocks. Now, with that being said, there is absolutely no reason, if you're somebody watching this video and you're watching something on par with like a meme tier list for investing, you shouldn't be touching options really at all under any circumstances. At the end of the day, it's just fast mode for wiping out your account. It might be possible to wipe out your account faster with options than it is penny stocks. And again, one of the other things that bumps it up to the E categories, there is a legitimate use for options. A lot of people with large portfolios, let's say they have a ton of shares of the S&P 500 ETF, they'll write something called covered calls on those shares. And that's a way of generating a little bit of passive income. It's highly technical. It's likely to waste a lot of your time watching and obsessing over it. Just overall, this strategy is highly dangerous. You can lose a lot of money quickly. There's very limited niche acceptable uses for it. And the ones that are on there waste a lot of time, and you have to learn all these technical terms. And frankly, maybe that time would be better spent learning a skill or improving your income at your job. So options solidly in the E tier, next to the normie who blows all their money at the club. Next up is technical analysis, the astrology voodoo of investing. So to a very unsophisticated person, they'll open up their first stock app and see all these crazily complicated bar charts, like, what is this, what's this? And so when they're looking at these charts and they're so confused, they think, oh, all this is necessary, important information I have to understand, not realizing that actually most of the time as an investor, you can just buy and hold. You don't have to look at these complicated charts and obsess over the data. Most of this is white noise, at least to the buy and hold passive investor, right? So as a result, the type of person who really gets confused and overwhelmed by those charts, but also feels the need to understand stock charts, they type up on YouTube and they end up on one of these low quality, low information stock channels that draws random lines on their stock charts. And they say things like, if this stock trades up, I'm going to assume that the price is going to go up. If the stock goes below this line, I'm going to assume that the price is going down and then trade based on the line going down. It means absolutely nothing. It's totally astrology and voodoo. This has been proven in studies. This has been proven mathematically. It is an enormous waste of time. But day trading, the good news is it's not as bad as penny stocks. It's not as bad as options. So as a result, this is solidly in the D tier. And the reason for that is because you're likely to waste hours and hours of your time learning absolutely useless information, but you're not as likely to lose your money dramatically quickly as compared to options and penny stocks. It'll just slowly bleed out as you overtrade. And once again, the SEC's got your number. I'll read the statistics on this. The SEC breaks it down into two categories, active trading and noise trading. So active trading is where they do ongoing regular buying and selling of investments. They purchase investments and continuously monitor their activities in order to take advantage of conditions in the market they perceive as important. And the report on the SEC concludes that the active trader generally underperforms the market. And then also there's something interesting too called noise trading, which I think is more relevant to technical analysis. Read this, it's really interesting. Noise trading occurs when an investor makes a decision to buy or sell an investment without the use of fundamental data, that is, economic, financial, or other qualitative or quantitative data. Noise traders generally have poor timing, follow trends, and overreact to good and bad news in the market, which is exactly what I said. There are clips of people on YouTube when they're talking about technical analysis on these stocks. They say things like, okay, this is the trend line. If it goes up beyond this, I'm going to assume the stock's going to go up. And then if it goes down, I'm going to assume it goes down. There's no rhyme or reason or rationality to it. And so you shouldn't be surprised that this is a D-tier strategy. Again, the only saving grace is that you're not as likely to bleed out your account as quickly as with these other strategies. That puts it in the D tier. And it's actually really interesting. I'm going to make a video about this generally, but active trading is really one of the worst things you can do to your portfolio. This is an interesting read. According to the study, active traders underperform the market. Active trading correlates with overconfidence. For example, in Boys Will Be Boys, Gender and Overconfidence and Common Stock Investment, Barber and Odin find a correlation between male overconfidence and excessive trading, particularly when comparing single men and single women. Because women are less likely to indulge in excessive trading, they outperform men. And in Online Investors, Do the Slow Die First, Barber and Odin determined that the investors who use traditional brokers, remaining in touch with them by telephone, achieve better results than online traders who damage their performance by trading more actively and speculatively. And this has been generally proven again and again, study after study. The more you obsess and spend time on your portfolio, the more active you are in it, the worse your performance will be. And I have a ton of examples from this from my personal life, actually. Before I switched to ETF investings, I would pick individual stocks, and this is documented on my Telegram journal. I barely beat out the market, and actually at the end, I think I ended up matching and tying it, and then in the final years, I was beneath the return to the market, right? And meanwhile, my fiance, I got her into investing, but it is torture. She finds investing so boring. She hates it. It is torture for her to even open up her investing app. I have to push her to open it. And surprise, surprise, she bought Apple and just held it, and she did better than I did. And that's because she doesn't obsess over minutia, and she doesn't have maximum overconfidence in her abilities to pick stocks. And so the same thing happens to these technical analysis guys. And a lot of guys are going to ignore this information because unfortunately it's portrayed in a very feminist attack on male sort of way. But unfortunately it also correlates with my experience. That's the same thing I've seen too. And this is another great example in this study too. I had shares that were on a telephone only broker, and I managed to keep those shares, I think literally from like age 13 all the way through my 20s because it was such a hassle to interact and trade with them. And then surprise, surprise, they grew a lot and I still have them all those years later. Whereas if a stock is sitting in your investment account, you're looking at it every day. And every day you're presented with the decision, do I buy, do I sell, do I buy, do I sell, right? And so it takes a lot of discipline to not be overly active in your account. And so people who do active trading and technical analysis, they have this disorder, this overconfidence disorder, but to a greater degree. It's already hard enough as it is with ETFs, but also when they think that they're supposed to be hyperactive in the market and trade every single up and down, every time they're trading, they're accruing more and more changes, they're in and out of the market, and they're more likely to underperform. Next up is gold investing. This one's very popular during times when there's economic uncertainty. But the problem is, a lot of these times aren't actually because there is economic uncertainty. I have a clip of Peter Schiff back in, I think it's 2010, saying the dollar is going to collapse, it's no longer going to be the reserve currency, and he's one of these guys that sells gold. And so there are two approaches people take to gold and silver investing. They either buy it in these paper ETFs where the company collects a fee on just running the ETF, and they sell these paper certificates that have a claim on their gold and they trade on the stock market. And the results are in. Gold, because it's not a productive asset, generally does not outperform stocks. So here we are on the S&P 500 ETF. You can see year to date, as in to this day on the year, it's grown about 11.5%, whereas the gold ETF has grown 1%. That is a massive underperformance. If we expand out to 1 year, gold has gone up 12%, but also the S&P 500 has gone up 16%. So barring a few key exceptions, this generally happens with gold over its lifespan on the stock market. It lags behind the S&P 500, and it's just a continued siphon of value away from investors. It's not as bad as the other strategies, but it will underperform something like a broad ETF. And so there's another way people that invest in gold is that they actually buy physical gold from a site like APMEX. And those sites also have fees and shipping issues as well. And generally what gold investors do is they just stack these gold bars and gold coins, and they literally sit in their closet and don't do anything and don't sell. And so really at the end of the day, the end of an average gold investor's life cycle is that the gold gets passed on to their heirs and maybe they cash it out at some point. Buying gold is a little bit better than the normie with his checking account because I know gold investors and oh boy do they hold on to their gold. They never sell. They sit in closets collecting dust. At the end of the investor's career they actually are more likely to still have their gold that they bought at the beginning as they do at the end, but it doesn't generate much on top of that. So it is better than the normie in E tier. We're going to put the gold investor, though, solidly in C tier, just because there's a lot of waste of time, low quality information YouTube channels out there. They say the economy is going to collapse every single year. It doesn't. They encourage people to buy gold, which is a non-productive asset. The only saving grace is that I guess potentially it might be useful in a bad economic situation. But even then, every single historical account I've seen of people, those times cash is always king, even in places like Argentina or wherever else. And it doesn't generate much passive income in of itself. And so that's a C tier investment strategy. Okay, next up is hype stocks. As in, these are the kind of guys that chase every single hypey stock because Tesla blew up once, and so as a result, they're a genius. They know how to pick every single great stock. This is a very complicated, difficult one to talk about because there are high-profile examples of people making a ton of money in stocks like Tesla, but also a lot of those same people end up being convinced that they're a genius even though it was luck, and end up buying trash stock after trash stock over and over and ruining their gains, turning into the average investor. And as we know, the average investor on the stock market underperforms inflation. So if the average investor underperforms inflation, then you would think, well, then isn't that a D tier? Isn't that worse than gold? Well, we got to talk about that and think about that for a second because sometimes people do win. There actually is a legitimate element of chance here. Unlike things like with penny stocks where, again, structurally it's rigged against you, the chances of you winning are so astronomically low, it's almost not even worth talking about. In fact, it is not worth talking about. With these hype stocks, sometimes due to random fluctuations and sometimes the person sells at the right time, sometimes they do win. But thankfully to solve this issue, I've got some data about this and it should be interesting. Watch this. In All That Glitters, the effect of attention on news on the buying behavior of individual and institutional investors, Brad Barber and Terrace Odian show that although the individual investors are net buyers of attention-grabbing stocks, where have we heard that before, stocks that are new in the news, stocks that are in the news or that experience an abnormal one-day returns or trading volumes, these stocks subsequently do not perform as well as the stocks that the same investors decided to sell. Meaning that just because an investor finds the right stock, it doesn't mean necessarily they'll sell it at the right time or choose to sell it in the right area, right? And so through the combination of all these factors, there are some high-profile winners, but the people who get those wins aren't qualified enough to capitalize on those wins and routinely make the same investor mistakes and also become massively overconfident. I put this in the same route as technical analysis. Now, this was a very difficult call. I almost put this in the C tier because there was a slight slimmer of a chance that someone through random fluctuations or luck will sell their hype stock at the right time and then that's it, be done. But this is like gambling. These investors get a taste of one win and they keep doing it over and over and over and over. So hype stock investing is a D tier strategy because I've seen these people on YouTube again and again and again. They're going to go right back to the roulette wheel thinking they're a genius and buy yet another hype stock. And most of the times these hype stocks don't win or underperform the general market. This is a D tier strategy. All right, next up is blue chip investing, value investing, as in diving deep down into the fundamentals of companies, buying quality, ignoring the garbage, building a solid portfolio, following the principles of Warren Buffett and Charlie Munger. Even though Warren Buffett just says you should buy a broad index ETF, let's ignore that and let's try to buy quality, like Berkshire Hathaway does. This strategy is not the worst I've seen on YouTube, and I'm just going to put it away right here. This strategy is a solid B strategy. And this is by no means an endorsement of it. This strategy is still extremely high in the time wasting category. It probably wastes less time than even gold investors, and it definitely wastes as much time as these hype investors who obsess over news over Tesla or whatever else is the hype stock right now. And that's because these value investors spend all this time looking into the fundamentals of the companies, and at the end of the day, they end up buying so many different blue chip companies, they're effectively creating a shadow version of the S&P 500, just with more concentration. And at the end of the day, you can see this GIF right here. It takes just a few seconds to buy a broad index ETF of the entire market, or just the S&P 500, or all the stocks in the world, like with VT. So for people doing this, they will perform maybe a few percentage points behind or a little bit ahead depending on random noise and fluctuation. they'll perform about as well as a general S&P 500 ETF. But the downside of this is while they're busy being a value investor and looking into the fundamentals of all of these companies, they could have just done 2 clicks, buy an ETF, and be done with it. This is unfortunately a very high time-wasting strategy. But what gets it up to the B category, and again, this is by no means an endorsement, is that there aren't that many scammer channels inside of this niche on YouTube. And also, at the end of the day, you're buying effectively like a paper tiger version of an ETF. So if you're buying like an S&P 500 like ETF, you're going to get returns pretty similar to that. So the harm is a lot less lower than everything else on this list. But remember that the bar is pretty low. I certainly don't endorse this kind of investing, but most people in my life do this kind of investing where they buy blue chips they like and ignore blue chips they don't. Value investing, blue chip, pseudo ETF investing, that's a B tier strategy on YouTube. If these people could just realize that the tens of hundreds of hours they spend obsessing over the news on these stocks could be spent towards getting another skill or building up their career, I think they'd realize that they're wasting so much time and they don't value their time as much as they should be. Next up is dividend investing. So this is a really interesting one. Dividend investing is actually more structurally inefficient than just buying a stack of blue chip companies, pretending you're an ETF when you're not, because dividend investors incur tax drag on their account. Because dividends are taxed, whereas capital gains are not taxed until you sell, dividend investors structurally will underperform other investors. But here's the thing. This has been studied. Dividend investors actually overall have a higher return than other investors because at the end of the day, they're not buying trash, penny stocks, or trading options, or losing their money that way. The consensus method in investing is that you buy a broad range and then hold it. You buy and hold. And dividend investors unintentionally have stepped into really one of the strongest strategies on the stock market, and that's buy and hold. And that's because passive income to them is so exciting and makes them feel so good. They love passive investing. They buy dividend stocks and they never sell. They hold, hold, hold. Even if it goes down, they just buy more, buy more, buy more. And so not because of the dividends they're doing well, they're buying well because they're incentivized in an entertaining, engaging way to take part in one of the most proven effective strategies on the stock market. And the results speak for themselves. Sure, these dividend investors have some pitfalls. They chase high yield, and there are a lot of trash companies that have high yield but negative total returns. Like there are stocks that they buy that have a 20% yield on their dividend, not realizing that the stock is dropping by 30% a year, meaning they lose 10%. But ignoring those few bad examples, the dividend investors also at the end of the day buy and hold, and you see more channels on YouTube from dividend investors who have multi six-figure portfolios, and you just don't see that from penny stock investors and option traders and technical analysis people. Dividend investors do really well at saving, but that doesn't save the fact that this strategy is structurally inefficient and it's not the best strategy on the stock market. But psychologically, I have to admit, this is probably the strongest strategy on this entire list, because even the blue chip stock method right here, it's very boring, it's very technical. Dividend is you buy it, you see a percentage, and cash goes into your account. People don't realize that dividends aren't free, they come from the company has to pay you, you're taxed on it. A dividend doesn't make a company great, but because they buy and hold so well and they buy large quality companies, dividend investors tend to outperform other investors on the stock market. Then finally, number 1 is ETF investing. So an ETF is you buy an exchange traded fund, a company for hopefully usually a small expense fee, bundles together a whole bunch of stocks, usually the S&P 500 or a general index, and they sell it as a single share and you can buy that. And just like the GIF I showed you before, it makes investing extremely easy and passive. This is an A tier strategy. And now you might be asking, why is this not an S tier strategy? And that's because there are no S tier strategies for retail investors. At the end of the day, it's slim pickings. You're just trying to make sure you save as best as you can and you don't get scammed. There are no S tier ways to becoming rich through retail investing. The best way you can become rich, this has been proven on my channel, is you have to make a lot of money either through entrepreneurship or a professional career of some kind and save well. There are no shortcuts. Investing can help you in a passive way in the background, but it can't make you rich all on its own. And so ETF investing is structurally the best strategy on this list, but it's only in the A tier because it can be very boring and there's not much to talk about. And that's a gift and a curse. So for people who love investing, which is weird, most people don't. Most people are normies down here. For people who love the industry, for people who love the field of investing, ETF is the hardest pill to swallow. It's boring. You buy and hold and that's it. There's no way to prove that you're a genius or do better than everybody else, but the math is in. ETF investors tend to outperform everybody else as long as they don't sell and as long as they don't get bored and start to backslide down into buying individual stocks. There are many ETF investors where they have something where they say, okay, well, I have my ETFs, but on the side, I'm going to have my speculation portfolio. And that's where all the perceived fun and excitement is. Then they focus on that portfolio and they lose and lose and lose and cancel out the gains they make just from buy and hold ETF investing. So it's not an S tier strategy because psychologically, it's not as appealing to the average investor as dividend investing is. And all these other lower tier strategies are fun. They're lottery tickets. Every single one of these people have a narrative about how I'm going to be rich, everybody else is foolish and mistaken. And ETF investors don't have this. They don't have this little secret narrative delusion, maximum overconfidence about why they're better than everybody else. Penny stock investors think they're going to 10x their money, just have to wait. Tesla investors think they've got the hype stock. It's going to take over the world, 20, 30, $1 trillion market cap valuation, whatever it is. Gold investors, they think that they predict the market collapse before everybody else. Dividends, blue chips, same thing, right? ETF investing just doesn't have that oomph, that excitement factor. But if we look at the chart right here, if you buy an ETF and hold, the S&P 500 generally outperforms the average inflation or average investor 5.6% to 1.9%. This can't be denied. So as long as you're psychologically able to take care of the fact that it's boring, which in reality should be a good thing, investment shouldn't be difficult and exciting and a bunch of drama. The only people who like to do things like penny stock investing, frankly, in my opinion, are people who don't value their time. If you buy a broad ETF, you're diversified, relatively safer than other types of investing strategies. That frees up your time to do other things like get new skills, improve your income, get a second degree, whatever it is. ETF investing is the A-tier strategy. There also, frankly, are almost no scammers in the ETF field other than pushing, I guess, these low-quality ETFs with high expense ratios, but the ratio of content on YouTube from scammer to decent is actually quite low. And this is why I'm an ETF investor as well. All right, everybody, that's all for this tier list of investing strategies. If I forgot any, I'll make a version 2, and let me know what you think down below. Also, there's links, check it out. I've got my guide, creatorheadstart.com, about how to succeed and make maximum money on YouTube. Maybe you've freed up some time not obsessing over stocks and just buying ETFs, and you might want to learn how to start a YouTube career. That's down for you as well. If you want a paid sponsor topic on this channel, you want me to talk about something you're interested in, check out the link down below. And go to the Telegram journal. I write advanced finance posts on there, and I will see you next time.